So as we near year end for business owners, being a CPA, I know you work with a lot of your clients on tax planning, and one of my favorite deductions is what I like to refer to as the drunken sailor deduction. I don't think that's the technical term for it, but maybe you could shed some light on how you evaluate from a year end tax planning perspective various options that business owners have to help minimize their tax burden.
Sure. And what you're referring to there, I think, is the let's spend everything and have no tax burden at the end of the year.
Exactly.
And so, yeah, the drunken sailor deduction is often just not the right way to go about year-end tax planning. Year-end tax planning, I think, is important. We start out with what are the basics of tax, right? There is no 100% tax. So anything that we are paying tax is a portion of what we made. It's not everything. If we're in the highest tax bracket, we're still retaining 60% of what we've made and hopefully collected. But the tax planning comes into play. It goes both ways. Traditionally you hear defer revenue, accelerate expense, and if the tax brackets are such that makes sense and where your year is, I agree with that all day long. So how do we do that? How do we defer revenue and how do we accelerate expense? Well, we defer revenue by putting jobs off until the beginning of the year. And certainly sometimes in construction that makes a lot of sense. Between the Thanksgiving holiday, the start of hunting season, and the Christmas and New Year holiday, we've certainly used to having a pretty light December in terms of production. And so maybe some jobs should be deferred and wait to recognize that revenue until the beginning of the year. On the expense side, it's a conversation of what we need versus what we may want. So what we want is really an expense that doesn't make a whole lot of sense from a tax planning perspective. Toys don't grow our business, but if we have some expenses maybe expected upcoming in Q1 of the following year, let's say we know XYZ truck is really giving us problems. We're going to have to buy a new one in February if we're lucky. It's not going to make it through a plowing season or even through the next inspection. It's probably a time that we know we're going to make an expense in February. Why not accelerate that into December? And we'll get the total write-off for it in the current year. And if we have a loan on it, we can defer some of the cash flow on it, but still keep in mind that we have a future cash outflow on the liability.
So from a business owner's perspective who might be evaluating capital purchases, capital expenditures, whether it be toward year end or at any time in the cycle, how do you help them think about the money that they're considering spending, the equipment they're considering buying, and evaluate whether that expense makes sense?
Well, it's a usage, right? And it's what kind of revenue can that equipment generate? In any industry, it doesn't make sense to buy something we don't need or we're only going to need one time. There's leasing and rental options for that. It's looking at capital purchases really come in two buckets. It's a replacement of current equipment that may be not functioning well or costing more to maintain than it is to purchase new, or it's what equipment do we need to pursue a new market or an increase in growth that we're considering or entering. So it comes down to what can we generate? What's the return on investment? The ROI is important consideration in any purchase, but especially in one sizable as a capital expenditure. We're not buying big pieces of equipment that have sit around and collect dust. They become very expensive paperweights, and the reality of it is, if you're only going to use it on a job or two, it's unlikely to ever get the revenue out of it.
Yeah. How do you assess tax rates now versus tax rates in the future and help determine whether it makes sense to push off recognizing taxable income or whether it's better to recognize it this year? And there's a whole bunch of applications to that, but how do you think about that?
Yep. So looking at what this year's profit is going to start with our baseline of what this year's tax rates, what tax bracket we're going to fall into. That into what projected revenue we have for the following year will be in consideration. And then we're looking at climates of, really political climate of what likely tax changes we may or may not have. We're in lower tax brackets than we've seen in a long time. We have some additional deductions on the pass-through entities with the 199A or the 20% deduction. And that has driven our overall net tax down, and where it may make sense to defer even when you may not want to pay any tax. It may make some sense to pay tax today, assuming things are going to continue to grow and be better in the future.